Hi, I'm Sean. I'm a startup builder and investor, and I've partnered with Scott from Max Business School to create this fully free course at Index Institution because we think everyone should know the secret to becoming wealthy. By the end of this video, you will 1. Understand the investing system that can get better results than most professionals and takes only 3 hours per year, 2. How to buy your first passive investment in minutes, and 3. A super easy way to choose the best time to start investing. Alright, now let's get started. Hey everyone, welcome to Investing for Beginners. So this is going to be the first video, an introduction video that will explain everything and set the tone for the entire course of Investing for Beginners by Index Institution. So thanks a lot for being here. We're going to basically teach you how to build wealth the best way with minimum time and stress. Sounds pretty good, right? So let's just go over exactly what we're talking about. So first, a quick disclaimer. This is a free educational course. It does not include any investment recommendations. You're responsible for your own investment decisions, and investing always has the risk of losing your money. You should always recognize this. No matter what content you consume or where you learn, you should always understand this risk. Now, first off, quick introduction. Who are we? Our names are Scott and Sean. First, about myself. I studied economics at university, started my career building out a startup that then became a billion-dollar business. So this would be Sender here. And then switched over to briefly becoming an investor in startups. So I worked at Hummingbird Ventures. And then there's my co-founder, Scott, who also studied economics at university. We're actually brothers, the two of us. And he built up a successful online education platform called Scott Max Business School. So you may know from scottmax.com or Max Business School directly, which is an education platform that helps over 120,000 active students to develop their skills to succeed in the digital world. So thinking about website creation, online businesses, etc., as well as a whole plethora of skills in the online world. And together, we've partnered up to build the Index Institution to help people maximize their financial health and grow their wealth over time in the simplest way possible. So in Max Business School, we've also provided education for free. And we want to do the same in the financial world because we think this is a right for everyone to know. So first off, we grew up not knowing how money really works. So we moved around a lot, but we never really developed any assets. Our family were educated professionals. So our dad was an airline consultant, our mom was a gemologist, but we never really spoke about investing outside of education. And education is for sure one of the best, if not the best, thing you can invest in to improve yourself, make yourself well-rounded, and have the skills to develop a proper income for the future. But even though we didn't grow up with a background knowledge of traditional investing, so financial investing, we still had an ambition to learn about it in order to understand the secret of investing. So how do the rich become rich and generate wealth, and how do they build generational wealth, not just for themselves, but also for their family and their future? So we got on to learning it. So the two of us each started spending a lot of time reading on personal finance and investing topics, and we both formally studied economics. But we found that the true secret to investing isn't actually taught properly in our education system at all. So then our work life started after university. Scott started his education business, which became a huge success. And I started working at my startup. So it was exciting times and things were working out pretty well. We were both pretty busy helping others maximize their income, building out these businesses. But then we noticed something. Most people who are actually getting high incomes from what they were doing were still often living paycheck to paycheck, meaning that they weren't really having any savings or investments built up for themselves. You know, if the job were to suddenly stop, they would have no pool of security to rely on. And they were never really building anything long-term for themselves. So now that we were earning some income ourselves and started having access to wealthy mentors, so in my case, the founders of my startup, as well as all of the backing investors of the startup, we had access to all of these valuable mentors, and we discovered something. And what we discovered was that investing isn't as hard as people actually think it is. People often think that it's something very, very difficult, that only people who have studied finance or have worked in investment banks or financial advisors think that it's this very complicated, rocket science with all these financial terms that no one understands. And it's actually done on purpose. They don't want you to understand it. They want you to make it think that it is rocket science, that it's super complicated. But in reality, it's kind of like driving or riding a bike. Once you know the basics of getting from A to B, and it sort of just then sticks with you like a muscle memory. So it's pretty much like riding a bike. It's not complicated like rocket science. It's just getting from A to B, knowing the basics. Of course, you can get fancy. You can do tricks or whatever, like riding on a bike. But the fundamentals, pretty much everyone can learn. You don't need to be a finance guru. You don't need to study finance. You need to know just the basics. And the basics will already completely transform your financial life. So Like I said, the financial industry wants you to think investing is hard so that you let them invest for you. So they'll be like, hey, we're a private banking service or a wealth management service. Give us your money, we'll invest it for you. And they charge you fat fees, huge percentage fees that eat away at your potential gains. So let's say we'll charge you 20% of whatever it is you gain in profit, or they might even not even earn you any profit. And you just have an incremental increase of maybe 3-4% per year. And they also charge you a management fee of 2-3-4%. So basically, you're not really making any gains. And this is something that, to be honest, you can do it yourself because, as mentioned, it's not rocket science. It's like riding a bike. You can take control of your own finances. And so we noticed that people who were clients of ours, from whether it's the Max Business School, helping people develop their digital skills, building websites, running digital marketing agencies, or from my own tax optimization business, helping people optimize their income, keep more of their own money, but they were still stuck from actually building real wealth. And like we said, it seemed too complex for them. They were often asking these basic questions, and they didn't want to deal with old guys in suits that are always trying to sell them something and charge you large percentage fees for just doing the basic managing of their wealth and investing it, which is something that we can do ourselves. Like I said, it's not rocket science. It's like riding a bike. And we'll show you how it's so simple. So we decided to take what we've learned from our businesses, books, and wealthy mentors, and my personal history with investing, and boil it down to something easy and digestible so that everyone can learn simply for themselves. Most people charge thousands of dollars for courses like these. I am firmly in the free education camp. We think that everyone should be able to learn this. And please, if you really enjoyed this video and you felt like you learned something, please share this with a friend or a relative or whoever you think might benefit from this. So, what if I taught you the exact same investment system that the best performing investors in the world use so that you can use it to invest your own money and grow it? And what if you knew that this system only takes 3 hours per year? This is part of what we're focusing on full time. So we help people maximize their finances with our businesses, and it comes in 2 parts. Part 1 is, like I said, my own tax optimization business, where I help people maximize their income. So help you legally optimize taxes to keep as much as possible and protect from the taxman. My brother Scott, who leads Max Business School, he helps you generate your income and develop your income in the first place through the world of online business and online marketing or website creation, etc. But that's not our focus today. Our focus today is in helping you, once you have your income, whatever income that you have, helping you build true wealth. So helping you multiply your income to build true wealth long-term in the simplest way possible. The simplest and most time-efficient way possible. Because we have our own things that we want to do in our lives. We want to focus on our jobs, our incomes, our businesses, or just going to the gym or mental health, etc. You want to keep it simple, but you want to keep it effective. So that's our focus here. So who is this course for? So you can put it into 5 different groups of people. People who want to protect against inflation and grow their wealth. We'll explain this a little bit later. Busy people who want to invest passively, so that you want to spend your time doing other things. You just want to take the building of wealth to have something that, takes care of itself. This is for both locals growing up in the same country and expats who are moving around between countries. This is for both beginners who are ready to start investing, but also for experienced investors who want to improve with a better system. So some of you may already be investing for a while. You might be stock pickers or you might be traders, and you realize you're just not getting the results that you want. You're always underperforming versus the market, and it's taking so much time away from you. This is a better system that is more effective that you can learn, and the best investors in the world, such as Warren Buffett, support this method, as well as economics Nobel Prize winners. And we'll get onto that in a second. So, first question, if you're saving money, why invest? This is a question that often a lot of people ask. So there are 2 reasons. The first one, like I said, is to protect against inflation. So what happens to my money with inflation? It will lose value over time, mostly 2% every year. Recently, in recent times, ever since the COVID pandemic, as well as the Ukraine crisis, it's been more like 5-10%, in some countries far more. But, why should I care so much about inflation? Just imagine it like this. The government comes into you and says, we have passed a new tax, 5% of the total value of your savings every year. This is basically what inflation does to your savings. And obviously, if you heard something like this, you would freak out. You'd be like, what the hell? People just pretty much just taking my money away from me of what I've built up. This is pretty much what inflation does. So in other words, Keeping your money in cash or just sitting in your bank account means that you're actually losing money every day due to inflation. And pretty much, like I said, 5% just gets seeped away from you every year. This is how inflation works. For example, if a baguette costs $1 or euro today, and in 1 year's time it costs €1.05, then basically the value of your $1 that you had previously just goes down. If everything becomes more expensive, the money that you have is worth less. That's basically how inflation works. So now we've got the first reason, which is protect against your inflation. And the second reason is to grow your wealth and earn passive income. Some of you here might just be trying to develop a passive income because you're preparing yourself for retirement, or maybe you just want more security. Some of you may know about the FIRE movement, so financial independence, retire early. And you're all about growing your wealth and earning passive income. So this is usually the two reasons why you invest. Sometimes you might not have a clear goal in mind. Sometimes it's just about the flexibility and security for yourself or for your family. This is completely normal. And these are usually the two reasons why you would invest. So the next question is, okay, I know I want to invest, but where should I invest? So people have probably come at you with all sorts of gimmicks and strategies, especially on social media, on Instagram, Facebook, wherever it is. And they come at you with all these different things such as day trading, buying real estate, etc. And we'll go through one by one, some of the issues with this. So for example, day trading, you'll see a lot of people being like, hey, I just earned $10,000 this week or this month through trading. And just to give you the short of it, we'll explain this a lot more later in the presentation, but it's impossibly hard and most lose money in the long run. This is almost like a statistical guarantee that you will be losing money. We'll explain this more later. The second one is buying real estate. This is actually a fantastic method to build wealth, but the issue is it requires a large lump of money, which many of you might not have, and it is a lot of work, way more work than you might actually realize. Third, we've got buy crypto. Especially during the 2020 craze, everyone was like, yeah, buy crypto, become a millionaire. It is a very high risk strategy and it's hard to understand. It's not a reliable strategy. Some people will get lucky. Obviously, people who have invested early on before the hype came around, generated a lot of money. And there are some people who deal in the crypto space that do well, but these are people that are very far down the rabbit hole who have spent years focusing on crypto and know fundamentally how it works and what to look out for. But for almost everyone watching this video, I can guarantee this is not the case. So please avoid crypto. It's too high risk. It's not reliable, which is what we're going for here. We're looking here for a reliable strategy that works for the long term. Then we have do Forex. So Forex is foreign exchange trading. So this is about buying and selling currencies, such as US dollar to euros or buying yen. So it's also very high risk and hard to understand. You'll see a lot of this on Instagram about Forex trading. Please just avoid this. It's not a reliable strategy. And then you've got other things like investing in peer-to-peer loans. I will just even ignore this because there's not even any point to talk about it. These are all just gimmicks to basically sell you things and make money off you. So let's actually talk about real estate because it is actually a good strategy. It is actually a pretty straightforward way to build wealth, but a lot of work. And I'll tell you why. First off, actually finding the time to find a good deal to flip. This is very difficult, A, to identify what is a good deal, and then B, actually being able to find it in the first place. You have to go through a lot of listings, and then once you find the deal, you have to deal with the renovation, you have to deal with finding tenants, the legal costs of actually buying the property and maintaining it, any sort of additional fees, inspection fees, mortgage costs if you use mortgage, if you use debt, maintenance costs just maintaining everything in order to make sure that everything's running properly, and the whole time burden and admin of actually managing it all. So overall, it is actually a good way to build wealth, but there's a lot of effort and barriers along the way. It's not an easy thing for you to start out in, and also all the time that you're using to build up the capital to be actually able to afford the down payment, it usually takes quite a while, and over that time, you're losing against inflation because it's just sitting in your bank account. So secondly, shouldn't I just start day trading like I see online? In short, unless you're a professional or you're willing to spend all your time focusing on this, no. As mentioned, it's way harder than it seems. Most people work in the industry for years to get good. People spend literal decades working in hedge funds and investment banks to really perfect this to a science. And whether you do it professionally or whether you do it as an amateur, to get good at it, and even if you're bad at it, it still takes so much time and stress. It's not the easy and lazy way to do things. You're constantly on your laptop. You're constantly on the news. You're always trying to look for better information to try to beat the market. And most actually fail at this. So in the end, by far, most people actually lose money. with studies. This particular study that I'm referencing, you can find in the Motley Fool, which talks about a study made in Brazil following retail traders over 300 days, finding out how many of them actually lose money versus actually those who gain money. And they found that 97% actually lost money in the long run. So overall, it's not the way to go. And the rich don't trade to grow their wealth. Even if you start to get good at it and you start to get lucky, really question yourself whether or not after your normal job, after whatever it is you're doing, whether it's your job, your business, your freelancing activity, if you really want to, once you finish at 5 or 6 p.m., then go home and spend another 5, 6, 7 hours all the way to, till midnight trying to practice how to be a good trader. It's not a very efficient use of your time. You should be spending time either working on your main business or your job or spending time with your family. There are so many other things that you could be doing. And the wealthy don't do the trading to grow their wealth. There's a reason why they don't do this. So I actually chatted to my mentors and I was talking to them about this whole, real estate, trading, and all these things that I kept hearing about online. And one of them just chatted to me saying, stop trying all these hacks. It's either gambling, which is basically what trading is, or it's just taking time away from you enjoying your life or putting more time into what's actually increasing your income. Actually focusing on your job, getting that promotion, getting that new job from another company, or if you're working on your business, really focusing on that to really scale that income. So what you should do instead is stop trading, stop wasting time, and start investing. And what is investing? It's about buying an asset that creates wealth for you over time. And what creates the most wealth in the world? It's companies. They're basically money printing machines for shareholders. That's why companies fundamentally exist. Obviously, they fundamentally exist to create value in the world. But in the end, it boils down to shareholder value. So they pretty much print money for people who own the business, which are the shareholders. And I first thought to myself, is it really that easy? Is it really that straightforward? Just invest in companies? So he was like, okay, let's look at how billionaires actually invest. The number one investment by billionaires, what makes up the majority of their portfolio of how they invest is actually company stock. So buying a piece of a company. So don't trade, just buy stocks. And the first question that you might think is, how much money will I actually make from investing? This is a question that I asked about myself. You want to know what are the results that I should be expecting. And this is the most natural question to ask. And a good number to base your head around is 9% per year, which is based on the last 50 years in global stocks, specifically based on the MSCI World Data, which is basically a tracker index that tracks the global economy as a whole from December 1969 to the filming of this video, March 2024. And you might ask yourself, okay, 9%. Is 9% annual return big or is it small? Is it enough? Because 9% feels like a small number, right? And when I found this out, I was pretty confused. Like, is 9% actually worth it? Should I be spending my time on this? Or in reality, actually no time because it's so time efficient. So actually, I went ahead and asked my boss at the time, so the founder of the startup, as well as his backing investors. And they said, Sean, stop thinking like a poor person. Poor people say that they want to get rich quick, but rich people understand and instead think compound interest. Now let me show you what 9% compound interest does. What does 9% mean? So he dropped me with this quote from Albert Einstein that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. And I'll show you what I mean. So let's go through an example. So at the time, I had 10,000 euros in my bank account that I was waiting to invest. And he said, okay, let's take this 10,000 euros and invest it. So with 9%, after year one, you're going to earn 9% on this 10,000 euros. So you'll get an additional 900 euros after the first year. Pretty simple, right? Now the next year, you'll be generating 9% again, but not on the 10,000 euros, but instead the 10,900 euros. So 9% of the original amount plus the interest that was already accumulated, and you'll now get an additional 1,069 euros by year two. Now in year 10, if you keep following this pattern, and you keep on getting further 9%, not on just the original 10,000, but also the additional amounts that you had per year from the accumulating interest, by year 10, it will have grown to over twice the amount with an additional 10,700 euros. And then by year 20, it starts to continue scaling upwards up to 56,000. So we've over 5x'd our investment. And by year 30, you can see here, let me just move myself, that it overall grows by 13 times. So you can see this hockey stick effect where each year, where you see, 10 years here, 10 years there, that the increase is drastically larger because 9% compound interest, what compound interest means is that it exponentially grows over time. So by the end, my 10,000 euros grows to 132,000 euros without me doing anything. So if we were to compare this versus saving, if we compare, let's say, 9% compound interest versus a savings account where at best you'll probably earn only 1%, where actually in reality it's probably going to be less. You might be wondering here, okay, over time, you see here the difference between 9% versus the 1%. So you tell me, saving at 1% or investing at 9%, which seems better to you? So obviously the answer is here, investing at 9%. Obviously a huge difference on your wealth, on just the starting 10,000 euros. So in short, the best way to get rich and stay rich reliably is to take the money that you earn and invest to multiply every dollar or euro that you earn. It doesn't matter what currency that you earn in, it works in everything. So now over the short term, stocks and investments will rise and fall and rise again and then fall again. But history shows us that over the long term, it increases. So we have our 3 steps of get income, buy stocks, and multiply every euro that we earn. So you think, okay, I know what I need to do. I know I need to buy stocks, but which ones do I pick? You've got stocks like Netflix, Amazon, Nvidia that's been doing really well over the last few years since the boom of AI. You've got companies like Microsoft, you've got Alphabet, you've got Apple, you've got so many. And the reality is it takes actually a lot of time to look through and read company financial statements and understand the news and market trends to really pick out the winners. And this is what hedge funds and stock pickers focus on day in and day out. That's their profession. Big value investors like Warren Buffett or hedge funds, etc. And all of these funds that focus on this to really choose the winners and beat the market. But I don't actually want to spend all that time looking at stocks and investing in individual stocks. I have other things to do. I don't want to spend all my time when I get home back from work, working another shift of 4 or 5 hours, reading about so many things every single day to pick out the best winners. And I'm sure you watching this video, you also have your own things that you want to do. Maybe you just want to focus on developing your skills for your job. Maybe you're learning a new skill, a certification, or just going to the gym, spending time with your family. You've got other things to do, right? You don't want to have this take up so much of your time. So my promise to you is that by the end of this video, we'll show you 1, the system that can get better results than most professionals and only takes 3 hours per year. 2, how to actually buy your first passive investment in minutes. So we'll actually show you this during this video. It's going to take a few button clicks. And then number 3, a super easy way to choose the best time to start investing. So let's start with number 1, the system that can get better results than most professionals and takes only 3 hours per year. So the way I discovered this is that I was actually helped out by a list of book recommendations by my mentors, and I took a look into their portfolios. So you have things here such as the Little Book of Common Sense Investing, The Intelligent Investor, The Simple Path to Wealth, and The Psychology of Money. Definitely by far, I would say the first book, if you were to have a read of these books, the first book you should read is Psychology of Money. I think it's by far the easiest to understand, and it goes through a huge range of concepts in each chapter, talking about money and how you should be investing it, and also how you should be treating it, and how to think about money overall in your day-to-day life. I think this is probably one of the most impactful books that you can read, and it's very easy to read. Then after that, I would say the Little Book of Common Sense Investing. This really goes into index funds, which we'll talk about later on, which was where I discovered how index funds work. The Simple Path to Wealth is also great. And then The Intelligent Investor. So Warren Buffett here on the right describes it as by far the best book on investing ever written. I agree. It was a huge paradigm shift in investing at the time. It really teaches the concept of value investing. I, however, think it's a little bit dense, dry, and outdated, but it's still a great book to read. It's just a little bit boring if I were you. So I would just, stick maybe to these 3 books. But overall, if you're into the finance dry stuff, have a look at it. It is a fantastic book. But more importantly, beyond these books, I was also able to look into the portfolios of my actual mentors to understand how they invest. So actually having a look into how really wealthy people invest. And they all introduced to me the same biggest financial weapon. and that's the index fund. So I know it seems a little bit complicated, but I'll explain what an index fund is through an analogy. So let's say you enter a candy store and you have 10 euros to buy candy for Halloween. So you go into this, you see this wall of maybe 50 or 100 different candy types, and you're wondering which is the best candy, like which is the best stock. Do I buy one type of candy or do I buy multiple? And if so, which ones do I have? I only have 10 euros. And the answer is, actually, you just buy all of them. That's very common that you have in these stores, like a sample mixer where it's like a bag of all the different candies that there are. And you're going to try some. Some are going to be amazing. You're going to be like, oh my God, I'm so happy. Some are going to be overall, good. You're enjoying them. And there might be a few things, like a few maybe licorice bands or some pieces of candy that you're not really a fan of. And you try that, not really your thing. You put it to the side. But overall, you enjoy the majority of the bag, and some of the ones in the bag, you turn out to be your favorite. And overall, you have a really, really positive experience because you're like, okay, I tried a lot, and overall, I had a great time. Now, similar to our candy store, there are many different public stocks and companies to buy. And the reality is, we can just buy the whole market. That's what an index fund is. It is a fund that seeks to track here. This is an example of the S&P 500 index. So similar to our wall of candy, this is basically the wall of stocks that there are in the market. And you buy a little bit of every single company matched to their relative size in the market. So like you buy all the different candies that you get, all in the same bag, all part of the different sectors, and you get all of it at the same time. So with index funds, you don't just buy tiny companies. That's not how it works. You just buy a piece of the most valuable companies listed on a stock exchange. So this picture was the 500 biggest companies in the US, also known as the S&P 500. In all the different sectors, you've got the Apple, you've got Microsoft, you've got Alphabet, you've got Pfizer here, you've got Meta, Amazon, all the big ones that you know, but also the smaller ones. So Visa, MasterCard, P&G, Citibank. You buy them all at once when you buy into the S&P 500, which is an index fund. And my first reaction to this was like, isn't this a bit silly? Seems a bit, simple but crazy, but also, sounds kind of stupid. But that reaction was wrong. And I'll tell you why. With index funds, you get the combined results of all major companies in an economy, or to be more accurate, in a market. So in other words, you buy a piece of the world's overall prosperity. So some companies may do worse, some companies may do better, but the key result, the combined result, is quite powerful. So from Psychology of Money, we'll have a quote here of, with index funds, you can be wrong half the time and still make a fortune. This is the side effect of buying the whole market, is that you kind of expect many companies to do poorly, but the combined result of, the ones that do poorly, the ones that do overall well, and then the few companies that do really, really well and really drive the whole performance of the market, you get all of it in one go and you still make a fortune. That's the whole point of index funds. You can't really go wrong. And what's the proof of this? The 9% that we were talking about. The 9% average gain over the last 50 years on average across the world's countries' index funds. So the World MSCI Index, here's a screenshot. You can see here since, where we start here in, let's say, 1975, and it goes all the way slowly ticking up. You see it goes up, goes down. It goes down during the crashes, it goes up again, and it keeps on rising and crashing. But on the overall, it grows over time. Some companies die, some new companies enter the mix, some companies completely change the world like Google did, or companies like Amazon, they all really drove the market. And if we buy into all of it, we never really know who the big winners are going to be. But if you're part of the whole market as a whole, you get the benefit of all of it. So, and it gets even better. Index funds actually beat the competition, and they do so with less risk. When you buy stocks individually, you're exposed to too much risk in these individual stocks. Some might do very well, some might do very poorly, but you're limited to these few stocks, and your portfolio might be down by a lot. And the reality is that index funds actually beat 75 to 95% of other actively managed investment funds that are run by professionals. So the source of this is Morningstar, the active passive barometer. So some of you may know Morningstar. It's actually one of the biggest financial news and research outlets in the world. And they have this active passive barometer, which is basically a measurement of how well passive index funds do versus actively managed funds. And in the end of year 2023, looking over the last 20 years, it differs slightly according to the region that you're in. So whether you're in, Northern Europe, Southern Europe, in the US, but overall, this range is accurate that 75% to 95% get beaten by index funds. And we see this in news sources across the entire world. We've got financial sources like Wall Street Journal, Financial Times, Investopedia, Reuters, the New York Times. They all crown index funds as the top performers. You see the headlines here. Index funds are, crowned as the new kings of Wall Street. And there's also actually a recent source that I've seen recently that actually the amount of money going into index funds has now, as of this year, 2024, is actually more money pouring into index funds than actively managed funds, because people are realizing that index funds and investing into the market as a whole, rather than trying to beat the market, is actually more effective. And they're actually the highest performers, therefore. So we're looking here at Eugene Fama, a Nobel Prize winner in economics in 2013. And even he says, I buy the market through index funds. So if one of the greatest minds in economics and maths, so pretty much the world economy as a whole, says, I buy the market through index funds, we should listen to him. So secondly, we've also got Warren Buffett, one of the greatest investors of all time with his net worth in the hundreds of billions. He's actually consistently outperformed the market as a whole. So he really understands what it means to be an investor in public market companies. And even he says by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. He even has a very famous challenge that he used to do, where he actually bet any investment fund manager $10 million that if you can actually beat the market consistently, you will earn $10 million from him, no questions asked. That was to the level of his confidence that of how actually difficult it is to try to beat the market with individual stock picking, and why index funds supported by him and some of the biggest investors and financial asset managers in the world like Vanguard and BlackRock, huge behemoths managing trillions of dollars, they all go through the method of index investing. So this is actually specifically from his 1993 letter to the shareholders of Berkshire Hathaway, which is the investment management fund that he leads and is a huge success to this day, managing billions of dollars. And in short, what we learn from this is that with index investing, you get competition beating returns for minimum effort and minimum risk. You don't spend all your time trying to invest in particular stocks, trying to spend all the time into it and having the big risk of if that company goes bust or there's a news scandal that you suffer a personal huge hit. With index investing, you can negate all of this. Plus, you can do it yourself. You no longer pay fat fees and commissions to investment managers who try to do it for you and who actually do it to worse results. And it actually takes you about 3 hours per year. This is why it's a huge game changer for all of you retail investors watching this video. So, in short, we had our 3 steps of, get income, buy stocks to ultimately multiply every euro that you earn. And now we can switch buy stocks with buy index funds, a much better method. So buying an index fund, that actually sounds pretty complicated. I mean, index fund sounds like a complicated term. How do I actually do it? And actually, I'll show you right now with number 2, how to buy your first passive investment in minutes. So let's go through an example of buying a popular index fund in Europe. So here we'll be going through specifically the iShares Core MSCI Europe UCITS ETF. I know it sounds like a mouthful, but we'll explain it's actually not that scary. And also, this demo that I'm about to do, we might be buying the iShares Europe, or we might be buying another popular index fund, depending on where you're watching this video. So if you're in the UK, or if you're in Spain, or if you're in the US, this video, whether it's the broker that we're using or the index fund that we're buying, will be tailored to you, because we want to make sure that this course is relevant to where you're watching from. So hopefully you picked out the right country before watching this video, so that we can show you in the demo what's relevant for your country in specific. So now it's demo time, and let me show you. All right, now we're in the brokerage app. Here we're using eToro as an example, but you can just use any brokerage app that you're familiar with. So there's Lightyear, there's Plus 500, there's so many, but we use eToro as the example where we do the one-to-one tutorials on. And here we'll go into the search bar. We already have it as a recent search, but you can just also type it in as well. So if we go on here, we then see the information, everything that we want to know about the index fund in question, any posts relating to it, etc. But what's simple here is you can just click trade. You can set it to whatever amount you want to buy, set the leverage to 1 times, and then you press buy. And then it will receive your order. And then once the market's open, then you'll have it secured as part of your portfolio. All right, done. That's it. That's how simple that it needs to be. As you can see, in a few button clicks, you've already bought your first investment. And that's as simple as it is. And like I said, it's like riding a bike. You just click a few buttons. It's very simple, and we'll teach you how to understand it. So in the end, it's as simple as it needs to be. Get income, buy index funds, and multiply every euro that you earn. And we've just shown you how easy it is to just buy a simple index fund. So now you might be wondering, is now actually the best time to invest? This is one of the most common questions that we receive. Everyone's always wondering, when's the best time to invest? And we'll talk about this now. The super easy way to choose the best time to start investing. So, we can't predict the future, but we can look at the past and think, when was it actually a good time to start investing? And the answer is, it was never a good time. There was always reason for doubt and to be scared. So we'll talk about a few scenarios. So in 1999, some of you may not even remember this, but this was something known as the dot-com bubble, where internet stocks were completely ballooning over time. The world economy was very overheated. Prices were skyrocketing everywhere. Japan was at the peak of its era. We had internet stocks going crazy in the stock market. People were wondering, hey, this can't be normal. The things just skyrocketing so much, things increasing by 40, 50, 100% within a year. It seemed crazy, right? It seemed like a bubble. And in the reality, yeah, it did crash in the early 2000s. Later on, the dot-com bubble bursts. The stock market took a bit of a dive. And then, there was always a reason to not invest because you thought, okay, just before the bubble pops, you never really know that things are a bubble before it pops. It's always a bit of speculation. You never really know. But in the end, it was actually a bubble, and the stock market did take a dip afterwards. And then in 2005, we had the housing bubble. So this was before the financial crisis started. Property was the big way to build wealth. It was very easy to get a loan to buy property in the US. But also across the entire world. There was a huge housing development across the world, and it was reflected also in the stock market. Banks and financial sectors were doing really, really well. And then in the end, in 2009, the bubble had burst. It was the global financial crisis. It was actually the biggest financial crisis since the Great Depression in the early 20th century. And things were looking terribly. The stock market was at an all-time low. Could things go even worse? It's down at the bottom, but maybe society could collapse. There's going to be a huge debt crisis. Will countries just completely collapse? Things could go down even further. Maybe I shouldn't be investing my money, even though everything's very cheap because stocks are down. I'd rather just wait it out and see if things are going to get better. And then things did get better. Things developed a lot well over the next years. There was a European debt crisis for a while. But, fast forward to 2016, everything was doing pretty well financially. But then you had a huge shift in the political world with elections of Donald Trump or Brexit. No matter what your political views are, whether you support things like Brexit or Trump, everyone can agree it was a huge shift in the whole landscape of the world. And people were wondering, is there a crisis coming? Will there be political or economic conflict? Will things pop? Is now a good time? Is now a bad time to invest? I don't really know. There's a lot of things changing. And then even fast forward to now. In 2024, we just came out of COVID, and now we have the Ukraine crisis and the Palestine-Israel conflict happening. There's war, there's huge inflation still in some areas of the world, and there's a huge wave of AI. Will AI take over the world? Will they destroy our jobs? Will they create jobs? We don't really know. There's a lot of uncertainty. And the reality is, that's why there's always reason for doubt and to be scared in all different periods of time. Because whether things are going very badly, like in the financial crisis, or whether things are going well, like during the housing bubble, or in 2016, during the longest bull run in history, when things were seemingly going well, there's always reason to be scared. And in the moment, it always seems risky. But in the long term, there were actually great times to enter, all of them. So whether it was 1999, during the dot-com bubble, where things then crashed, in 2005, when things were going well, and then it crashed again in the global financial crisis, And then later on, during the huge political shift that the world saw, it was a huge crisis for many. But overall, no matter what time you're entering in the long run, it increases. Even to now, today, to 2024, people might wonder, will it crash again? But even if it does crash, it will always be a great time to enter. So what would be the profit that you would have had since 1999 if you actually constantly waited for the best time to invest and you never actually invested? The answer is 0. That's what your profit would have been. Now, what would have been your average return if you consistently invested the same amount every month during that period of time? Now, that number would be 8% per year. So based since January 1999 to March 2024, so the period of time that we looked at, you would have gained 8% per year over that period of time. So you might still be wondering, okay, seems interesting, but how about if I end up investing at the wrong time in each year consistently? Is it still good for me to be investing? What if I get unlucky and always invest at the worst time in the year? So we'll actually look at this experiment run by Charles Schwab, one of the major investment services companies in the US. There are a lot of other websites and newspapers that have run through this experiment. We'll just take the one from Charles Schwab, where they actually looked at the 20-year returns leading up to 2022 of 5 different characters given $2,000 at the beginning of each year to invest into the stock market. So the first character, Peter Perfect. Now I'll just read out here. Peter Perfect was a perfect market timer. He had incredible skill or luck and was able to place his $2,000 into the market every year at the lowest closing point. For example, Peter had $2,000 to invest at the start of 2003. Rather than putting it in immediately into the market, he waited and invested on March 11th, 2003, that year's lowest closing level for the S&P 500. At the beginning of 2004, Peter received another $2,000. Again, he waited and invested the money on August 12th, 2004, the lowest closing level for the market for that year. He continued to time his investments perfectly every year through 2022. So this guy was perfect, always investing at the right perfect time in the market. Now the second character, Ashley Action. Ashley Action took a very simple but consistent approach. Each year, once she received her cash, she invested her $2,000 in the market on the first trading day of the year. So she took immediate action. The third character, Matthew Monthly. Matthew Monthly divided his annual $2,000 allotment into 12 equal portions, which he invested at the beginning of each month. This strategy is known as dollar cost averaging. You may already be doing this through regular investments in your 401k plan or some other automatic investment plan, which allows you to deposit money into investments like mutual funds on a set timetable. So in short, he split his investments across the year. Now the fourth character, what everyone worries about, is Rosie Rotten. So Rosie Rotten had incredibly poor timing, or perhaps terribly bad luck. She invested her $2,000 each year at the market's peak, so the most expensive time. So for example, Rosie invested her first $2,000 on December 31st, 2003, that year's highest closing level for the S&P 500, and when she received her second $2,000 at the beginning of 2004 and invested it on December 30th, 2004, the peak for that year. So she always had the worst luck possible investing at the most expensive times of the year, which is generally where you don't want to be investing in. Now the fifth character, Larry Linger. Larry Linger left his money in cash investments using treasury bills as a proxy every year and never got around to actually investing in stocks at all. He was always convinced that lower stock prices and therefore better opportunities to invest his money were just around the corner. So Larry always wanted to wait. This may be many of you watching this video where you're always waiting for the better time to invest and the money is just sitting in your bank account. Now, the results are in. Obviously, perfection won, but early action and consistency were close behind. So let's look at this. Peter Perfect, obviously, number one with 138,000. No surprise there. Someone who's perfect at timing gets the best result. But Ashley Action here, she just invested it immediately into the market, and she did worse. She got second place, but is close behind only. Matthew Monthly, who was consistent, did also a little bit worse than Ashley Action, but pretty close, I would say. And overall, they're doing relatively okay. They're a little bit behind Peter, but not by that much. The reason why Ashley Action actually does a little bit better than Matthew Monthly is because she took most of her money to invest it at an earlier point in time, so her money had more time in the market to grow and compound by itself, whereas Matthew Monthly split it over time. Both methods are actually very popular and effective. And then Bad Luck here obviously did a lot worse than Peter Perfect, no surprise there. And then we have Rosie Rotten here, so who represents Bad Luck, only $112,000. Obviously, this is worse than Peter Perfect and Ashley Action and Matthew Monthly. No surprise there, doing quite a bit worse. But overall, she made an overall gain. The point is that Bad Luck was more than double the result of Larry Linger, who kept waiting. And that's the point that this experiment is trying to show, is that you could be perfect, which is very unlikely, and you do very well. But action and consistency are the best things to do. But even if you have the worst luck possible, you're still more than double the result as someone who waits. So that's what I'm trying to show here. Bad luck is still better than not taking action at all. And the lesson that we should learn from this is that market timing is actually a fool's errand. There's no point trying to wait and time the market. And even if you do it really badly, if you still keep doing it every year, you're going to be way ahead. This is a quote from Robert Merton, a Nobel Prize in Economics winner in 1997, one of the greatest minds in economics overall. And he confidently recognizes that trying to stress out over it is pointless. So which would you rather do? Stress out waiting for the perfect time, or just stay relaxed, invest consistently, and get better results? So what have we decided from all of this? Number one is invest, so beat inflation and grow your wealth. Number two is invest in stocks. So invest in companies because companies are the things that create wealth. Using index funds as it gives you excellent results for only 3 hours per year. And doing it every month. So just stay relaxed and just invest consistently, make it automatic. So invest in stocks using index funds every month. That's basically what we decided. Seems very simple and straightforward. And that's what we want. And congrats! Now you know all you need to do in order to become a successful investor and build true wealth. Now the biggest opponent to you is delaying. Don't be like Larry Linger. So think about, what would it mean to you if you could build real wealth and live off passive income? Some of you may have heard about the FIRE movement, which is financial independence, retire early. So that might be your focus. You want to maybe quit your job, retire early, go traveling, whatever it is you want, and you don't want to think about money because your investments are already generating passive income for yourself. But maybe that might not be what you're going for. Maybe instead you just want to get enough resources to buy a house, make some sort of big purchase for your family or for yourself. Or maybe have some financial buffer to start a business, take risks in your life, pursue what it is that you want to do. And even if any of those goals don't seem attractive to you, just think about what would it mean to you if you could at least protect your money from inflation and grow it so that you can have freedom of choice later for whatever it is that you want to do. This is usually one of the biggest key indicators of happiness in life, is the sense of feeling of control. So that you have control over yourself, that you have the right to, to take a few days off, whether it's from your business or from your freelancing activity or from your job, that you say, hey, I'm willing to leave this job, take the risk to find a better job that either pays me more or is better for my passions because I know I have built up a pool of wealth that allows me the freedom to do what I want. Freedom of time, freedom of choice, freedom to spend time with your family and do what you want is usually the biggest key indicator of happiness. Now let's keep those motivations in mind and use it. So what happens next? In the next videos along this course, we will go through a few key steps. So in Module 1, which is the start of this module, we'll be setting up a brokerage account and understanding your future goals and vision and how to get there. Module 2 is actually learning the brokerage account. So no matter what country you're in, if you selected the right country for watching this video, we will teach you how to learn the right brokerage account and navigate it to use the basics of the account and understand fundamental risk and investing concepts that you can apply to yourself. And the module will mainly be focused around a lot of button clicking, a lot of practical one-to-ones that will show you, how to click, how to buy and sell different things, what's in the broker for you to understand, so that you know in terms of muscle memory what everything does, what to ignore, what's important, etc. And then in Module 3, we'll be going over core concepts, so actually explaining and expanding on the best practices of investing and how to actually practice them in the account. And then in Module 4, we'll actually shift over from demo mode to real mode. So actually making your first real investments, understanding fundamental key concepts and understanding fundamental tips that will make you a successful investor in the real world and the challenges that come along with it. And then in the end, we'll have a couple bonuses. So if you go through all of the modules and you complete the milestones, you'll get a coupon for our tax tailor. So if you're someone who's a freelancer or a business owner, we can help you reduce and optimize your taxes globally. And then number two, what's actually more important for many of you is the local tax modules. So depending on the country where you're watching this video from, a lot of people wonder, hey, how do I deal with the taxes on my investments? We'll have a video dedicated for each country so that you can understand what are the local tax regulations that you need to know about, how do you need to declare your profits and gains, how do you go about actually declaring them, and everything that you need to know about that to make sure that you're fine, you're protected, and everything's clean. And then the bonus number 3 is what we'll be working on in the background, is making additional modules where it's like short summary and explainer videos of some of these bigger books that I mentioned before, like Psychology of Money or Little Common Sense Book of Investing. Some of these books that really help a lot in terms of changing your perspective on how you view money and investment strategies. We'll be making videos explaining those. So, in this course, you can expect to see easy to follow tutorials where, here you have my brother explaining one-to-one what you need to do, what the different dashboards mean, how to click this button, that button, how to not make mistakes that a lot of people do. So an example of this is, choosing the wrong leverage amount for your trades. We'll be explaining that you should always set to 1x leverage. We'll explain this later on in the modules, but we'll pretty much show you what to ignore, what not to do, and what you should be doing in order to not make costly mistakes and lose your money. So, what can I expect? At Index Institution, there are no tests, there are no exams. We focus on a practical education with milestone practical exercises. So you feel confident in your understanding and you'll be implementing and practicing these things on your own as your own little course project. And the demo account that you create will, in the end, be your own live brokerage account that you own forever. That account will ultimately be your first investment vehicle, where you'll be making your first real investment and you'll consistently use it to build wealth over time. So, by the end of the course, you will A, be invested in your own index portfolio, so you'll go from zero to invested no matter where you live. Knowing what you are doing, so you'll be a confident and relaxed investor. You'll be in charge of everything when it comes to your portfolio management and fundamentally understanding what everything means. And finally, you'll be a passive investor for life. So you'll build your own passive investing plan for growing your wealth in 3 hours a year or less. Very minimal to maintain. You'll just want to check in every few months to adjust things, and then you can focus on going back to your normal life and having the building of wealth be automatic. Plus, there's a bonus. You'll get a thank you voucher from us. Like I said, the €50 voucher to our tax tailor service if you finish and post all the practical milestones throughout the course into the community and send us an email to graduate@indexinstitution.com with the link to your profile, and we'll help you sort out your taxes and optimize if you fit our criteria. All right, so we're almost done. If you like this video, please share this with others. Help us grow the community. I really want this community to stay free because I think this is the type of knowledge that everyone should know, and we really should be teaching this in our schools, to be honest. So if you really liked what we're trying to do here and want to help us keep it free, please share either this video or the community or however you found us. Just share it with a friend, with a family member, or whoever might be interested in investing or growing their wealth. So yeah, that's basically that. Now we can finally get started. See you in the next video. All right, bye-bye now.